Well, hello and welcome to Utopian Global. This is Bill Rao, the founder and CEO, speaking to you. Actually, I just arrived back from Dubai today. I'm now back in right on the Swiss and German border. So it's great to be here on another Money Matters issue with Carolita Oliveros, our international attorney. And before introducing you to Carolita, I want to welcome everyone joining us from many parts of the world. It's great that you take the time to come onto these calls. I don't think there's certainly in my young history, and I've been around a few decades, I must say, the world at the moment is in really volatile, very sensitive, economic situations right now with trade wars, currency wars. So understanding money, understanding the topic that Carolita will be speaking about, which is really part two of the history of money. This is really going to be more focusing on from 2018 onwards. I mean, we've had a lot of changes in that time, a lot of currency valuation changes in that time around the world. So it's going to be a really interesting topic. But before I introduce Carolita, I want to always like to give a bit of an introduction of who Carolita is. You understand her depth of experience, and that we're really honored to have her presenting to us each month in the subject of Money Matters. But Carolita Oliveros is the author. She's a speaker. She's an international business attorney focused on working with clients in international business, e-commerce, international manufacturing, distribution, marketing of products and services, technology, intellectual property, protection, real estate investments, social entrepreneurial endeavors, and also, I suppose, even frauds, embezzlements in business as well. She gets called in to do those types of things. Carolita Oliveros holds a bachelor degree from the University of Florida in the USA, a master's degree from the University of Texas at Austin, USA, and a Juris Doctor from the University of Arizona College of Law, USA. During the past 25 years, Carolita activities and accomplishments include faculty instructor at the McGuire Entrepreneurship Program at the University of Arizona, and the entrepreneurship program at Thunderbird American Graduate School of International Management, which is also in Arizona. She's an adjunct instructor at the Pima College teaching courses on business law, managing a non-profit organization and finance, faculty member for the Best Brilliant Ideas Business Plan Contest, 2010 to 2011, author of courses on leading and non-profit organization, instructor and co-author of the Rich Dad. People would know that name, Rich Dad, Poor Dad. You all heard that. You all know who we're speaking about there. Of course, Robert Kiyosaki. Well, Carolita was the initial author with Robert Kiyosaki in the very early days, putting personal finance courses together. She's also co-authored and was a founder and developer of seminars, workshops, educational materials, and coaching programs on recession-proof financial strategies and recession-proof investment strategies. Ms. Carolita Oliveros is the co-chair of the Arizona District Export Council. This is an appointment by the U.S. Secretary of Commerce. She's a board member of the Planet Arizona World of Trade Fair and a past chair of the Tucson Metropolitan Chamber of Commerce International Trade Committee, among many others, too numerous to list. I've listed many, but there's a lot more to list actually. So with that, Carolita, I'm going to pass the call over to you. Again, thank you for hosting these calls, sharing your wisdom, your global experience as an attorney, and speaking about money matters, which of course affects each and every one of us.
Thanks, Bill. It's always a pleasure to be here. I appreciate your kind words, and we'll just get started whenever you're ready. Okay, there we go. Well, hi everyone again, and welcome back to part 2 of the history of money. I was telling Bill just a few minutes ago that we may have to continue this. I'm not sure. We won't be able to get through. I mean, what we'll get through today is certainly a great deal of information. It's not all of it, though. There's some, as I'll mention at the end, that I just was not able to go through in detail, and I think it's really important. So we may continue with that next time. But right now, let's just launch ourselves right into where we're going. Well, Bill,
Yes, go ahead, Carolita.
There we go. Okay.
Yes, it's changed now. It's fine.
I think I'm going to have to turn my mouse off. That's probably what the problem was. Let me try this one time. No, it wasn't the problem. Huh. Well, I'll do it with the mouse then. As always, I like to tell you to think big. And today I'm going to ask you to think really big with me, because some of these concepts may be new to you. I'm not sure. You may have heard of some of them, and yet you may not have heard of others. So keep an open mind while we go through this information, if you will, because there are a lot of things that are happening in the global economic picture that we have not seen in many decades. So if you're a baby boomer and you're on that side of the equation, then you've probably been around early on in your life with some of the concepts and what was happening back in the 50s, 60s, 70s, 80s. If you're a millennial, maybe you haven't seen any of this happen. That doesn't mean it didn't happen earlier, but maybe you just weren't here to experience it. And so one of the things that we need to look at is, even though it hasn't happened lately, that doesn't mean that it cannot happen again, because history does, as we know, and one way or another, it does repeat itself. So we're thinking big. We're going to definitely think exponentially. Some of these concepts will be bold. Definitely, I hope to be strategic about the kinds of things that I tell you are your options. And clearly, we will have to be embracing change, because change is the name of the game today and every day in this particular part of the year. So, economics and the history of money, we went through that, and we'll just do a brief overview of that just to kind of refresh your memory. But today is part 2, and that's the history of money starting at 2018 and going beyond this. I mean, what are we looking at for this year, and what are we looking at for the future? One thing I can tell you for sure is that there is a new political reality. QE3, which is quantitative easing number 3, is here to stay indefinitely. As we know from the information that I provided to you last time, QE3 was never terminated, so it's still ongoing. The other thing is that debt is here to stay indefinitely, because we've got now more debt than we've ever had, probably in the history of civilization as we know it today. And it's not going anywhere anytime soon, because debt is now the new money. Because of the fact, and we'll look at this again as we talk about, because it's a major player in the conversation that we're having today, because of the fact that President Nixon in 1971 took the US dollar off of the gold standard. And probably when I said that to you on the last webinar, you probably said, well, so, okay, great. What difference does that make to me? Well, it makes a great deal of difference, not only to people in the United States, but people all over the world. Because when the US went off the gold standard, think about it. Every central bank held US dollars, because at that time, holding US dollars, well, from the time of the Bretton Woods Agreement in the 40s until Nixon took us off of the gold standard, all central banks held dollars because they were backed by gold, and it was as good as holding gold in the vaults. Dollars could be redeemed for gold, literally. So that's why it affects all of us, not just Americans, not just Americans in the United States, but everybody. So we're going to take a long look at that. So let's just take a fast reminder of what we looked at in part one. We talked about the education system and how that did not include any kind of financial education. And Bill mentioned Robert Kiyosaki. I was really blessed and honored to be one of the people, along with Craig Cottrell, that was invited by Robert Kiyosaki and Sharon Lechter to put together the Rich Dad Personal Finance course that was taught in colleges and universities all over the United States. And you'll hear me talk about Robert again because the education system is one of his favorite subjects. And he's a strong, strong proponent of financial education, which we have not had in the school systems. Certainly not in school systems in the lower grades. I mean, starting schooling up through high school. And very little, unless you are majoring in finance, in colleges and universities. So we talked about that, how the beginning of that came about, and we talked about the banking trust, which was the 7 major families who were in control of all of the banking enterprises. We talked about the Federal Reserve and how that worldwide system of central banks evolved out of the Federal Reserve, the income tax system, which the US adopted as law in 1913, and a strange system called the Mandrake system. And the Mandrake system was born out of the Bretton Woods Agreement, which came after World War II. So we went through World War I, we went through the Great Depression, we talked about the private ownership of gold and how in 1933 in the United States it became illegal for individuals, people like you and me, to privately own gold. So all of that was confiscated by the US government. And at that time, gold had a flat price of $20 an ounce. That changed. Once they confiscated the gold, the price of gold changed. So that was just another way of taking money from individuals. And we're going to talk about how the middle class is in jeopardy and how it's been losing money and having money taken from that segment of society for many decades now. So the Bretton Woods Agreement was signed. That spread the Mandrake system all over the world. And the Mandrake system was the central banking system, and everybody under the Bretton Woods Agreement had to hold gold or US dollars. They had to hold US dollars, which were backed by gold, in the central banks around the world. So that was the plan for the new monetary system. And then, as I mentioned, in 71, we came off of the gold standard. And at that point in time, money became a debt. And debt drove the system. So even though all of us, regardless of your age, all of us still talk about, well, we need to drive down the debt. We need to pay off the debt, because now in the United States, as well as many other countries, our debt, our national debt, is in the trillions of dollars. You know, nobody was even thinking about that many zeros back in 1971. But that's where we've evolved to. And that's how we got into the situation that we're in. That's the start of it. It has evolved since then, which we talked about. So we went to the Internet society and the electronic age. which then, of course, brought on electronic currency. In 2009, Bitcoin came upon us. And since then, we've got many, many cryptocurrencies. So it's the age of the crypto. Along with all of that, we had the crash of 2008, the global market crash, bank failures, the quantitative easing started. We went through quantitative easing 1, then quantitative easing 2, and now we're on 3 in the United States. Central banks around the world were doing their own quantitative easings, some of them even earlier than the United States. A couple of countries had even started, Japan in particular, had started quantitative easing way before the US did. From that, we got the bailouts. Central banks were printing money, literally. The joke was hit the print button, because central banks were printing money, bailing out Wall Street, bailing out corporations, and also, which turned out to be a point of great contention and a real sore spot with a lot of people. A lot of the money printed on the quantitative easing cycles went to pay off huge, huge bonuses to executives who in large part were responsible for the crash of 2008. That's another whole subject. You know, there are books written on that. The Big Short, if you ever saw the movie The Big Short, is all about that, written by one of the Wall Street insiders who was there at the time and witnessed what was going on Wall Street from the inside, which is how the movie came out. So we started out with the bailouts. Now we're to bail-ins. That started with Cyprus and the banking problems in Cyprus. And then 3 years later, that was in 2012, 2015, we wound up with the situation in Greece with the sovereign bonds and that whole problem, which has led us into a situation of negative interest rates. So let's start with what happened at the Federal Reserve meeting on July 30th and 31, which is just a month ago of this year. The Fed in the United States, and that's what we call it the Fed. The Fed had their meeting, and I think to the surprise of most people, they lowered the Fed rate from 2.25% down to 2.0%. And I say that that was probably a surprise to many people, because in 2018, at the meetings of the Federal Reserve in 2018, they had continually announced that they were going to be increasing the Fed rate, which they did. That's how we got to 2.25%, because they increased it. Well, the news was that they would continue to increase it over the next several years until they got to 3.5%. So when they lowered on July 31, they lowered the Fed rate back down to 2%. That was quite a surprise, and it caused quite a ripple in the economy, because lowering the Fed rate meant that instead of buying back assets, as the Fed had started to do at the end of 2018 or third quarter of 2018, buying back assets, that meant that they were going to be printing money again, because lowering the interest rate creates debt. and debt creates a devaluation of the currency. And so now we've got a problem that's not just with the Fed, but with other central banks around the world as well. And other central banks had already lowered their Fed rate because we knew for a fact that the European Central Bank was already at negative interest rates. In fact, a number of banks were already at negative interest rates. The European Central Bank went to negative interest rates in 2014. Denmark and Switzerland both had negative interest rates as low as a negative 0.75%. And interestingly, what that meant in Denmark, homeowners in Denmark could actually get negative interest rate mortgages. And I found that so interesting. One of my colleagues actually ran the computations and discovered that if you took out a 10-year mortgage at a negative interest rate, that you could literally, at the end of 10 years, wind up paying back less money than the amount that you borrowed. So that would be quite a deal, actually. If you had a mortgage on your home and you wound up paying less money on the mortgage than the amount that you borrowed originally. Actually, 17 countries in the Eurozone have negative interest rates. Negative 0.4%. So that's not as much as Denmark and Switzerland. But that's the negative interest rate on what we call central bank deposits. And central bank deposits are the amounts of money that central banks give individual banks for them to loan out. So they're actually getting the money that they loan at a negative interest rate, and then a number of those banks are loaning that money out at an even greater negative interest rate, if you have to stop and think about that. So what does it mean when we've got a negative interest rate? It's really pretty simple. It means that if you, the depositor, you, the bank customer, are putting money into your bank account and you're being charged a negative interest rate, then you are literally paying the bank money to accept your deposit. And that's in addition to any other bank fees that you may have been paying on that bank account. You know, we get charged for the checks that we write, if we still write any checks. Some people still do. Most people do transfers on their iPhone or their smartphone. So if you put money into the bank, that means that on top of all of the other fees, like the monthly charges that you might have been paying, now you're paying an extra amount of money just for the bank to accept your deposit. So for example, if you were to put 100 Swiss francs into the bank in Switzerland and leave it there for 12 months, at the end of 12 months, the original 100 Swiss francs that you put into the bank would then be valued not at 100, not at greater than 100, which is how it used to be when we'd make a deposit and leave it and we'd get interest on the deposit, positive interest. So we'd get back something greater than the 100. Now you get back 99.25 Swiss francs. So that's what happens on negative interest rates, just to give you a concrete example. When we cut the interest rates, I just heard a few days ago, I listened to a podcast between one of my colleagues who was interviewing Peter Schiff. And Peter Schiff happens to be one of the really well-known, very well-to-do, very, very tuned in investors, international investors. He's done some really interesting things, and sometime maybe we'll talk about him, but one of the things that he did that I find very interesting, particularly in the context of our discussion today, is that several years ago, after 2014, which many of you know, FATCA came into being. FATCA was the law in the United States, which is the foreign accounts transaction legislation that says that now every bank in the world has to report US citizens who have bank accounts there and report to IRS, the Internal Revenue Service in the United States, who these people are with offshore bank accounts and what they're doing with the money and how much money there is. And then all of us US citizens who have those offshore accounts, we also have to do a FATCA compliance and report it. Well, when you cut these interest rates, regardless of what currency you're holding the money in, the bank in, it cuts the value of the money and increases inflation. And that was sort of the discussion between my colleague and Peter Schiff. Actually, it was a conversation about gold that they were having, but you can't talk about gold without talking about what's happening to the currency. Because when the inflation kicks in and the currency devalues, the price of gold goes up. So what's the solution? Well, the short answer, and it's not the answer that the banks want to hear, and they dread it actually. And so there's a lot going on with regard to the war on cash, because the basic answer is, the solution is, don't put your money in the bank. If you don't want to pay the negative interest rate, if you don't want to pay the bank to put your money there, then don't put it there. Put it somewhere else. Buy gold and silver with it. Put it under your mattress. Whatever you do, just don't put it in the bank. Well, that's not the answer that the banks want to hear, clearly. It's not the answer that the governments want to hear. So the prevailing policy is to create more debt, put more money in the economy, which will cause people, this is the prevailing theory, it will cause people to save less because they won't want to put money in the bank at negative interest rates. So they're not going to be stockpiling money in a bank account, because the Fed doesn't want you to stockpile money in a bank account. They want you to spend money. If you look at the Keynesian theory of economics, which most of the central banks do abide by, most governments have embraced it. I can't understand why. I mean, when I had to study it in economics, I just shook my head. I couldn't believe it. But many people subscribe to it, and that's okay. If you do, we're stuck with it, apparently. So it says, don't save, spend more. And the government can force you to do that by creating more debt. At what point does it become an exercise in futility? Up to a certain point, yes, they can create a situation and drive inflation and drive the debt and provide more money into the economies around the world, giving us more money to spend. We can borrow money at banks to get home mortgages and loans for all kinds of things. They can assure that we're not going to be stockpiling the money in a bank account because the bank account's earning what, 0.05% or less. But at some point, injecting all of that cash no longer has a stimulating impact to the economy. Up to a point, it does. It definitely stimulates the economy. And we've witnessed that through 3 quantitative easings. We've witnessed that stimulation into the economy. But how long can you continue to do that before it no longer has that effect and no longer has that impact? And at that point, you're just driving the debt further and further. So what's the projection on when the next 2008 type of financial crisis is going to occur? Well, unfortunately, none of us has a crystal ball in order to be able to give you a specific answer. But what I hope to do today, because, you know, my whole goal is to provide financial information that hopefully will be useful to you. I guess it has been useful because for 5 years now, Bill keeps inviting me back to do more webinars. But what I did this time was to go through all of the prevailing experts and to distill down, because they don't all agree with one another, for one thing. Just like Peter Schiff and my colleague who was interviewing him could not agree and did not agree on whether or not you should be buying physical gold for hedging purposes, which is the position that my colleague believes is the correct position, or the Peter Schiff version, and that is buy gold, you know, get engaged in the stock market with gold funds and ETFs and buying stock in gold and silver companies that we call royalty companies. And we've talked about that on occasion in the past, and hopefully some of you are even invested in the royalty companies, because they don't actually mine the gold. They just acquire the gold from the miners and then pay you a royalty on the profits that they make off of the gold and silver and precious metals that they acquire from the mining companies. So, you know, that's one side of the equation, and then the other side is to hold physical gold and silver, which many of us do, obviously. But I'm taking all of that information and I'm going to give you Carolita's summary of where we are with this whole process, where we're going with it, and what our options are. Because the one thing that I do truly believe in, it's been the tenet of my professional life and certainly of all of the webinars and the conferences that I've spoken at, you know, the weekend seminars that I've given, all the materials that I've developed, it has been the one thing that I have been constant with, and that is that we need to look at options. Do not get mired down in the negative thinking that goes along with looking at an economic crisis. Whether you're looking at it from a third party point of view or whether you're in the middle of one because your country is in crisis and the banks in your country are in crisis. But what are our options? We have always got to be focused on that. So that's where we're going today with the rest of this discussion. What are the rules of money? Well, the rules of money today are not the same as the rules of money 10 years ago. Because the old rules of money, the rules that I grew up with, and probably Bill, that said, savers win. Save your money. Save for retirement. Save to buy big dollar items. You know, back in the day when washing machines and dryers first came out, or, you know, other big things. I mean, then we got big screen TVs, and those were big dollar items at the very beginning of their existence. So save your money, save your money. That was the pre-1971 rule. Because at that point in time, money had asset value. It was backed by gold. And the silver coins that we carried around had a large percentage of silver in them, pre-1965, before they started cutting the content of coins. So that was the old rule. Well, now we've got a new rule. I call this is my terminology, the post-2008 global financial crisis rule. Because after that, and after 1971, savers lose. Especially if you're putting money in the bank at negative interest rates, right? We've already looked at what happens with the Swiss franc. You know, you put 100 Swiss francs in, you get 99.25 back. So debtors become the winners in today's economy, which is a really strange thing for me to say. But it's true, because now if you borrow money, as we've seen, you pay it back with devalued currency, with devalued money, whatever that means in your country, and to whatever extent that it's devalued. So that's a whole new playing field. That's not the same rule that especially the baby boomers grew up with, and a lot of other people, because now we're being encouraged, literally, not to save. We're being encouraged to spend more and more. Well, one thing that I can tell you for sure, and Kiyosaki talks about this a lot in all of his books, and that is that there is definitely such a thing. There is a construct called the velocity of money. Because money loves speed. Money wants to be moving. In order for money to work, it has to be engaged. It cannot be in a bank account yielding 0.05% or less. That's stagnation. Money has to increase, it has to grow. So we've got to be able to move money. We've got to be able to use it in a constructive and in a way that provides growth. If you're going to save, and I'm encouraging people to do that, I'm not a proponent of not saving, because I think that we need to save up enough money to buy certain things. Well, save up to invest, okay? Because when you invest, then money is working. So when you save, have a purpose for it. Don't just sit there and say, oh, I'm going to save for a rainy day. Well, I'm here to tell you every day can be a rainy day. So have a specific purpose for it, and have that purpose be something that will invest the money so that the money can work for you, not against you, but for you. Okay, so we've said that the 1971 dollars are no longer backed by gold. Therefore, we talk about fiat money. Lots of people call it funny money. But the money became a debt, literally became a promissory note. A promissory note put out by the government and backed by the good faith and credit of the government to pay off on the promissory note. I think that's probably information that's now been disseminated widely enough that probably most of you know that. But if you didn't know it, then I want to just remind you that that in fact is the situation as we have it today. So starting in 71, money became a debt instrument. A promissory note is a debt instrument. When you take out a loan, you sign a promissory note. And that's basically what's been happening with the fiat money. So now by default, and I say by default because if it had not been for the Bretton Woods Agreement, and that was the edict for all central banks to hold US dollars, that was the expansion of the Mandrake system. By default, all central banks now held, at that point in time, fiat money, because the dollars that they were holding in the central bank around the world were not backed by gold, so they did not have any asset value. They simply became debt instruments in all of these central banks, which meant, quite frankly, that now central banks could print money risk-free, literally. Listen, they could create more debt without any risk because the debt was the money. When all of the printing started to happen, dollars, currencies of all times, started to devalue and inflation kicked in. So that's why today I say to you that debt drives the system, because that's how we got to the debt, and that's where the debt is. The debt is spread all over the world. It's not confined to the United States. It's everywhere. And I'm sure that all of you and all of the countries that are listening in on these webcasts are well aware that your country has got the same problem that the United States does, and that is that our central bank is nothing more than a depository for debt instruments. Recently, a number of months ago, Bloomberg came out with a report that I thought was really interesting. And it basically laid out the information that from 2001 up until the current year, to the end of 2018, that the US dollar lost 13.2% purchasing power. Well, that happens because of the inflation, right? Because money decreases in value, and that means that the same number of dollars, if your income has not increased, then you're operating with the same number of dollars, and that buys less than it used to buy 10 years ago, even a few years ago. So you need more currency just to pay for your ordinary living expenses. And in the meantime, I think we've all experienced that our living expenses are going up. The dollar is decreasing, or the currency is decreasing, and your expenses are going up because of the inflation. Well, here's the important point for all of us. Middle class around the world has been steadily declining since the 1970s, since the event of the US dollar no longer being backed by gold. That did not just affect Americans in the United States. That affected everybody worldwide. It affected middle class worldwide, because inflation negatively impacts the poor and the middle class. Well, we already know that people who are living on low levels of income have been greatly negatively impacted around the world. But I'm not sure that all of us who are middle class, because it's not affecting the 2% worldwide that are the mega wealthy, but I'm not sure that all of us who are middle class realize that we are a dying breed. I'm not trying to be melodramatic. I really mean this. And it's going to get worse unless we take the control of our lives and our finances and we do something about it to save ourselves. Because the governments are not going to do it for us. That isn't going to happen. It's certainly not going to happen in my lifetime. And if you're a millennial, it may not happen in your lifetime either. So the impact is really on the middle class. And when I say to you that there is a point at which putting more money into the economy by printing debt is no longer going to have a stimulating effect, that's a very personal comment to me, because I know for a fact that it impacts my life. But what I want to share with you is that it also impacts your life. And it may impact you in a more dramatic way than you had thought possible. Because eventually, historically, if you go back and look at history, and just about every expert that I have read their books, listened to their podcasts, subscribed to their newsletters, been to their seminars, personally sat and listened to them talk, every single one of them talks about studying history. Because as I said at the very beginning of this presentation, the things that happened 40 years ago, 4 decades ago, 5 decades ago, may not have happened again recently, but that doesn't mean that it won't happen again. Some of the things that have happened in the past have already started to happen. And one of the things is the devaluation of all of the currency. Sit down and take a look around. Look at Venezuela. Look at some of the other countries who've had their currency go to zero. It's not beyond the realm of possibility. It happens. It happens in modern day. When you've got raging inflation, your currency is headed to zero at some point. So the question is, when will this happen? If you live in a country that's not at zero, then when will your country's currency get to zero? And again, I'm not being melodramatic. I'm just asking questions that we need to be considering. There's an interesting theory called the complexity theory. And let me tell you why I think it's interesting in this discussion. And that is that complexity theory says there's not just one trigger mechanism for an event to occur. If you take apart the event and look at it, reverse engineer it, and look at all the moving parts in it, you will discover that every single event, every economic event for sure, has not just one trigger mechanism. It has multiple triggers. And they are all either operating in tandem with one another, or they're operating in a sequence. In other words, like the falling of dominoes. That definitely applies to everything that we've been looking at for the last 20 years at least, since the beginning of the 2000s. Some experts say it started in 1998 with the dot-com era. But keep in mind that we are dealing with a complex system, a very complex system. And every time there's a ripple in the complex system of economics, the ripple is caused by a multiple of factors. And how those factors impact one another, and then ultimately at the end of the day impact us personally. Let's just look at one writer whom I'm going to talk about a little bit later, is a man named James Rickards. And he's written, gosh, at this point, I don't know how many books James Rickards has written. He's a prolific writer. He's got an incredible history, and he's exceedingly well connected, and he's a prognosticator of a lot. He's been right so many times about what's happening. He's been an advisor called in to talk to Congress, told Congress what was going to happen. Congress ignored him, and sure enough, bang. 2 years later, what Jim Rickards said absolutely came to pass. Congress should have listened. But let's just start with the 2008 global crisis. That was, if you think about it in terms of a volcano or an eruption, and all of the foreshocks and the aftershocks. So we're dealing with the little shock waves that come before an event happens. And that would be things like the global crisis of 2008, the 2012 Cyprus banking crisis, and then again, 2015, the Greece sovereign debt crisis. Okay, those were foreshocks. The question is, when is the big explosion going to happen? And better yet, let's get closer to home and talk about what did we learn from those foreshocks? Well, we learned a number of things. Number one, we learned that banks close, that governments can shut them down. We've had bankruptcies in banks historically, particularly with small banks, community banks, not well-funded banks. The question always is, when you look at a bank to put money in, check out their financial statements. Learn how to read financial statements so that you can read the financial statements of the banks that you're dealing with, because you need to know what their liquidity ratio is. And sometime maybe we'll talk about how to read bank statements, because it's important, especially if you're going to open a bank account in a foreign country to get the money out of your country. You really don't want to put it just in any bank. You want to put it in a well-funded bank with a high liquidity ratio, certainly well over 10. The higher, the better. 13, 14, even better. So we've got banks that are closed, which means that everything in the bank is frozen solid. It's not that you can't get to your account. You can't even get in the door to the bank. So what's inside that bank is definitely out of your reach, which includes your safe deposit box, which is why we always say to you, and I know Bill has said it many times, as I have, as all kinds of other speakers have, don't put precious metals or precious jewels like diamonds and other precious jewels, don't put them in a safe deposit box in a bank, because they're not safe there. If that bank shuts down, you cannot get to your wealth, your physical wealth. And I guarantee you that the banks will go through those safe deposit boxes and open them up and take what you've got in there. I guarantee you of that. And for those of you who are bankers on this call, I apologize if I've offended you, but that happens to be the truth. And we've already seen it happen. Depositors' funds are frozen. ATMs are closed down. If you can get money out of an ATM at all, as they discovered in Cyprus and Greece, it's only a minuscule amount of money, and they dole it out to you on a daily basis. In some cases, it wasn't even enough for large families to buy groceries to feed them. You certainly couldn't pay your rent. You just got little amounts of money every day or maybe once a week, and you had to save those little amounts of money up just to make your living expenses because no cash was available. And that's a subject that we really do need to cover. And I've said to Bill, we need to probably include that on the next webcast. And that's the whole issue of the war on cash. But we learned two really important lessons. And one was the concept of bail-ins, because always in the past, especially in 2008, everything was a bailout. Governments were printing money to bail out the banks, to bail out the stock markets, to bail out the large corporations, to bail out the brokerage houses, and to bail out, unfortunately, the executives who had been responsible for a lot of what had happened. All of a sudden, we had a whole new concept called bail-in. Well, what on earth did that mean? Well, we got to know the definition of bail-in in a unfortunate way and at great expense to a lot of people, because basically a bail-in took money out of people's bank accounts to pay off the debts of the bank. So what you need to know about the money that you've got in your bank account, and I mean today, is that you no longer own that money. And I'm not being facetious. I really mean that. You do not own it. It doesn't belong to you. Once you put it in that bank, that money belongs to the bank. So for those of you who do not like reading all those little inserts that come in your bank statement or that show up when you log into your account online and you get a big screen and it has all this fine print written on it, I suggest to you that at some point you get a magnifying glass out and you start reading that fine print, because the fine print tells you that the bank can take that money. It can use it, in fact, and there is case law in the United States, and I imagine there's case law in many other countries as well, and that means cases that have where people have sued the banks trying to get their money back, gone to court, and it's gone through a series of different courts because it keeps getting appealed. But there's literally case law in the United States, which is now backed by statutory law, and that means that the legislature, the US Congress, as the parliaments in other countries, have passed laws that say that the bank can use your money in any way that it wants to. In other words, it can take your money, loan it out, or invest it And in 2008, the problem was that banks were investing in the derivatives market, mortgage-backed securities, which were being repackaged and repackaged and repackaged, as I told you when I explained the Mandrake system. And so those mortgage-backed securities and those derivatives that they were investing our money in from our bank accounts had no value, and it went under. That's what, that was one of the things that caused the crash. One expert that I read, a really fascinating book, and Bill, I'm going to send you a new updated reading list for the history of money, because I have a whole stack of books sitting here on my desk that I've reviewed, but one of them is called The Everything Bubble. And it's fascinating because the author of that book says point blank that the precursor, in other words, the foreshock to the crash of the derivatives market and the mortgage-backed securities, was actually months before that, investors who had money in the money market hitting the panic button, hitting the sell button on their money market accounts and requesting hard cash, pulling hard cash out of their money market. Well, trillions of dollars apparently were pulled out of the money market in that little panic. And according to him, in his view of things, that was the precursor that caused the crash. So regardless of which event in the complexity theory, which one of those little events you think was the trigger mechanism, as I said, it was multiple triggers. So those terms and conditions that apply to your bank account no longer just apply to the bank account. By legislation in this country, and I believe also it's true, I know for a fact that in England it's true, and I'm believing that it's true in other of the G20 countries, it also applies to your brokerage account. It applies to any insurance accounts that you've got money in. It applies to a whole lot of things that are hard cash sitting in. And we're waiting for the shoe to fall on what we call 401k accounts, which are retirement accounts, and IRAs, individual retirement accounts, that people put money in. If you don't have that money invested in hard assets, then I think that eventually there will come a day when governments will start pulling out money from those retirement accounts and saying to people, oh, well, since you don't know what to do with this money, we'll invest it for you and we'll pay you 1%. Well, if your country's dealing with negative interest rates, making 1% on your money may sound like a good idea to you. But I do think that there's a time, if you're not doing something with that money wisely, that you could lose it to your government. So read your fine print, please. Please, I've got my lawyer's hat on. Please read the fine print because it affects you. The other thing that happened was that the G20 summit on November 15th in 2014 in Brisbane, Australia, established a new global regulator. I'm sure probably many people on this webinar have no idea what I'm talking about. Because again, it was in the fine print of the summit proceedings. It took me weeks to find it. I knew that it had happened in 2014, and it took me a long time to go through all kinds of documents to find this little entity called the Financial Stability Board. I'm going to call it FSB for short. But the report that the FSB wrote, and I've quoted it here, or at least I've quoted parts of it here. bank losses should be absorbed by unsecured and uninsured creditors. Well, the creditors they were talking about, because we're all bank creditors, okay? When you make a deposit, we call ourselves depositors. The banks on their balance sheets call us creditors. Unsecured and uninsured. You're going to see those words again in a minute when I flip the screen. What does that mean? An unsecured creditor means that you're at the bottom of the totem pole when a crisis occurs because you have no security for the money, to back the money, wherever that money is. And uninsured means, in bank terms, like the Federal Deposit Insurance Corporation in the United States, other countries have similar entities that insure bank accounts up to a certain amount of money, up to 100,000, or in the US, up to 250,000. Well, if your money is in an FDIC, sorry, said that wrong, FDIC insured account at a bank, then up to the point that you've got 250,000, allegedly that money is insured. Now, there's not enough money in the FDIC. Actually, it has $1.36 for every $100 of money that needs to be insured. So there's no way it's going to insure all the FDIC accounts, but allegedly that money is insured. Anything over 250,000 in that FDIC account is up for grabs. It's not insured and it's unsecured. So whatever the amount is in your particular country, if you've got more than that amount in your bank account, and that's what happened with the people in Cyprus who had large amounts of money in those accounts, over a certain dollar amount, and I think it was 100,000, the bank could take all or a part of it. So the report goes on to describe the powers and tools authorities should have to achieve the objective. And the objective is to take the money that's unsecured and uninsured, include bail-in power and the power to write down and convert into equity all or parts of the firm's or the bank's unsecured and uninsured liabilities. Well, your bank account on the bank financial statement is classified as a liability. That's why I want you to learn how to read banking financial statements. It's classified as a liability. So to the extent necessary to absorb losses. In other words, they can take the money out of your bank account without telling you, without your permission, because you no longer own it. It wasn't yours anyway, okay? But it's yours to the extent that it's insured. At least you can get it back. I'm not sure that they say that it's yours, but at least you can get it back under the insurance program. But here was the crux of what this FSB entity, organization, was all about. And it reports to no particular, it's not governed by any particular country's governing body. Okay? It's a fiction created by the G20. Well, Robert Kiyosaki says that there are 4 factors that have stolen wealth from the middle class. And I'm going to say this because I think it's important for you to think about it. Taxes, debt, yours or the government's, inflation, and I put in parentheses, this is not Robert's word, but I put there, in effect, devaluation of the currency, because that's what happens when you've got inflation. And retirement. And as we all know, after World War II, the largest population of people born, certainly in the United States, but it's true worldwide, are that segment of the population that we call the baby boomers. And those people now are starting to retire and already have retired. I mean, the boomers have been retiring for a number of years now. So the money that they had put aside to support themselves in their retirement is either no longer there at all because they lost it in 2008 and never regained it. I mean, it's been 10 years. And if you look at the statistics on how much of that loss has been regained, it's very little. Percentage-wise, it's not much. Some people have never regained it. Some people went from middle class to poor instantly. So I think Robert is absolutely right. I think if you boil it down to the common denominators, these are probably the correct common denominators: taxes, debt, inflation, and retirement. So how can we protect our wealth? I don't want to leave you today without giving you a basic plan. And when I looked at what everybody was saying, I think that Jim Rickards, and this comes out of one of his books, and I've got the title of it at the end of the plan, so that you can get the book and read it if you haven't already. It was one of Jim's books that he put out in 2016. And as I told you, he's a prolific writer. He's got a whole book on the war on cash. But he says, okay, you need a robust all-weather. I love those words because I think it's really descriptive and all of us understand what he's saying. You need a basic plan that is robust and will survive any climatic changes to preserve wealth in the coming collapse and mitigate the asset freezes. Okay, all the downturns and all the asset freezes, the frozen cash in banks, the jewels that you've got locked up in a frozen bank in your safe deposit box. Find an off-site storage private company that you can put your valuables in, your art collections, your valuable jewels. I mean, whatever it is you have to store. If you don't have facilities at home, a big vault, a sunken vault, or whatever it is to store in at home, then find an off-site storage unit, but don't put it in the bank. Okay, this is a good starting place for uncertain times. It may not, everything on this list that I'm going to give to you may not fit you individually. It may not be something that you're well versed in. It may be something that you need to find out about. But it's a good basic plan, and he gives you the percentages of what you need to do, which I like, because people are always asking, well, how much of my wealth should I be putting in gold or silver? Or how much should I be putting in diamonds? Or how much should I be putting here or there in real estate or wherever? Well, this is a good basic starting point. For physical gold and silver or precious metals, it could be palladium, it could be platinum, could be rare metals, rare earth metals. 10%, coins and bars. And Jim says, which I agree with, and a number of other people have also said, no numismatics, not collectible coins, not unless you're an expert at them. If you're an expert at numismatics and you really know what you're doing, then great, go for it. If you don't understand the numismatics market, if you've never dealt with it, don't go there now, unless you can become an expert in a short period of time. Cash, 30% in cash, some in actual physical notes. In other words, physical dollars and coinage, or Swiss francs, or whatever your currency is. 30%, at least for a start. We'll talk about later. Real estate, 20%, but only in income producing properties or agriculture. Because as we've already said, money has to work. It has to be working for you. It has to be earning. So unless you know a piece of raw land is in the direct path of development in a big way, and you're going to be able to sell that raw land for a huge profit within a short period of time, that may not be your best real estate buy for the time being, certainly not to start with. But income producing properties and agriculture, great investments. Fine art fund. Now, whether you mean that you've got fine art, museum quality only, Jim says. And I certainly think that's a wise decision because it's got to have value. Again, it's got to be something that will sell if you need to. 5%, which is a small percentage because it's a high risk. Okay, that's probably one of the higher risk. Angel and early venture capital, 10%. Investments in fintech, in natural resources, in water, those kinds of angel investing. If you've got enough money to be in a venture capital group or to be in an angel investor group, then look only at fintech, natural resources, and water. Bonds. All governments put out bonds. Treasury securities, as we call them. That's another whole discussion. Jim says high quality sovereigns only, 10%. And you may wind up, depending on inflation, you may wind up having to sell those later and convert them to something else. Hedge funds, 5%. Global macro, long and short term equities or arbitrage. Stocks. In the stock market, 10%. Natural resource, mining, energy, utilities, tech, only those that are hard assets, okay? If you have a family business, that's wonderful, but don't count it among your investable assets. Your family business is your income. It's not, as we're considering this list, it's not one of the things that you're investing for other purposes, like to preserve your wealth. But all of the other assets that we talked about in that list, except for cash, stocks, and bonds, and this is important, they can be held by your owning the direct title to them. If you own gold or silver, you can physically own that, right? You can take physical possession of it, or you can own it in a contractual form. But the important thing is that you can do that without having to rely on the banks or on brokerages or exchanges or digital records. In other words, those are the types of assets that cannot be hacked. So you can control them, and that's really important. You want to be able to control as many of your assets as possible. Some of the assets that are on that list are not liquid. That is true. You cannot instantly convert them into cash. However, most of those are immune from asset freezes and lockdowns because they're not in banks, they're not in brokerage houses, they're not in other entities that the government can control the money, the flow. So the allocation that Jim Rickards proposes, I think, offers you a lot of protection from inflation, from deflation, and from panics, because we all know that, especially in the stock market, panics occur all of the time. The market is always volatile. Right now, it's on an upswing, but there will be a panic and the market will drop. And we've had a couple of them just in the last few weeks. I mean, there's always a little drop in the market when the Fed has a meeting and that announces what happens with the Fed rate. But you want to be able to allocate in such a way that it offers you protection from having all of this affect you in a dramatic way. Certainly it affects all of us, but hopefully that gives you some options to look at. You know, take this list. It's in Jim's book. Let me just add a couple of reminders for you, and that is to pay attention to your portfolio. You know, whether it's the basic list that Jim Rickards provides, or whether you've got your own set of items and percentages of where you want to put some money to protect yourself. But be vigilant about it and be ready to take action as you need to. This is not, I mean, we're no longer talking about, you used to be able to put money into an account, leave it there, and forget about it, and come back 20 years later and discover that you had X amount more than what you originally deposited. We're no longer in that situation. You cannot set it and forget it anymore. There is no such thing. So if you're among the baby boomers who used to believe in that philosophy, I implore you to please find a different philosophy. That one doesn't work any longer. Because as time goes by, cash allocation may need to be changed. You know, you've got 30% and the basic list that Jim provides. You've got 30% invested in cash. Some of that's in physical cash. Well, as inflation hits, you may need to move that money. Maybe you need to buy more gold with it, or maybe you need to put money into, you know, a collectibles art fund, or into some kind of real estate. You may also, if inflation gets really bad, you may also need to move money out of bonds. You may need to sell the bonds and put that money someplace else. So here's Jim's book. It's a great book. All of Jim's books are great. I've never read one that I didn't think provided immense amount of information, really valuable information. But this particular book with the list in it is The Road to Ruin. The subtitle is The Global Elite's Secret Plan for the Next Financial Crisis. And it's, Jim put it out, and it has a 2016 copyright date. So I know, thank you for bearing with me. I know we went way over time, but I really wanted to get through this information because I think it's so valuable. And believe me, we are a dying breed in the middle class. If we don't take care of ourselves, the government is not around to do it for us anymore. I mean, at one point in time in the history of the world, we could depend on that. And lots of people did. And lots of people now do not have pension plans because they depended on it. A subject again for another day. But thank you so much, Bill. I so appreciate your bearing with me, even though I'm running late today. And thank you everybody for attending.
Well, Carolita, that was an awesome presentation. And I mean, this is a serious subject, isn't it? And I really appreciate you taking your time out, your experience, and sharing it with our members around the world. No question about it. Understanding money is absolutely key. It was something that I was not taught at home or at school. It's something I had to learn. And your lesson today is really priceless. So once again, thank you, Carolita. You brought up some many great subjects. One, first of all, that you don't own your money when it's in a bank. You actually become the end of the line. You're accredited to the bank. That's really key. The law regarding bail-in laws. You spoke about Cyprus. I mean, even in Australia a couple of years ago, they very quietly passed the bail-in law. So banks get in trouble. They have the right to use your money to get the banks out of trouble. without your permission. And in Australia, I saw, Carolita, and you'll like this subject. In the last 2 weeks, we had one of our fellow Australian members who lives in Norway send me a file where Australia is proposing draft legislation where they're actually prohibiting cash transactions over 10,000. Because you spoke about negative interest rates where governments, because of the world debt, they can't afford to increase interest rates. They've got to keep them low to be able to service the debt. Well, in Australia, they're proposing draft legislation that anything over $10,000 will be totally illegal in businesses to be able to pay. And if any business accepts cash in excess of $10,000, business owners and people will face criminal charges. So this is it.
That's the war on cash, isn't it, Bill?
That's the war on cash, Carolita. And of course, the other reason being, too, of negative interest rates, as you quite clearly said, it costs money to have in the bank. So they want to disencourage people taking money out of the banks and use cash transactions. And these types of legislations that we'll see around the world will try and prevent people from hoarding cash. You know what I like to do? I like to hoard this, Carolita. I don't know whether you can actually see it or not.
I love the color of that money, Bill.
Yeah. Well, that one's 100 grams, a bit over 3 ounces, 3 ounces of pure 99.9 gold made at Argo Horizon refinery in Switzerland. And I just came back from the gold souk, and I must say the amount of Western people that you see walking throughout the gold souk, and of course all nations, buying bars, also jewelry form, high carat jewelry form as a form of store of wealth. You see that. So I think your percentage of 10% holding in cash is a good number. And the great thing about gold and silver, it's highly liquid. In fact, I just want to finish up with this note, Carolita. Again, this is quite amazing. You go back to the days of Robert Kiyosaki, Rich Dad, Poor Dad, back in the 90s, of course, when he first launched his books. And he talks about moving from, being a wage earner over to the right side of the quadrant, of course, to be a business owner and have multiple streams of income, those types of things. Well, this is what our people at Utopian Global have. You own an international business where, one, you can earn diversified commissions from different parts of the world for referring our products and services. You can buy gold and silver, take physical shipment, or you can store it in Zurich or Dubai, highly liquid. You want to sell back tomorrow, you just enter it in there, and within probably 48 hours, the cash is back in your account anywhere in the world, or actually even paid out in Bitcoin. You have the ownership of store, real tangible assets. These assets will be income generating assets. You are diversifying in real tangible assets. So here with Utopian Global, here are our education programs, such as Carolita Oliveros, Dr. Blue, Better Lifeology. I'm really grateful to all of you. And Carolita, thank you so much for all your time. I know you're busy. I know you've got to go straight to work, to some of your jobs after this call. So thank you, and thanks to everyone taking the time to listen in.
Thanks, Bill.
Bye-bye.